It has been a very, shall we say, volatile year in 2019 for the Fed. What do you think you've learned about the economy over the past 12 months?
While there's been a lot of volatility, we actually haven't ended up much different than what we expected last March. So if you look at where our forecast was for the end of the year, we thought that we'd get growth around 2%, a little bit above. We thought we'd have the inflation rate at 2% or a little bit below, and an unemployment rate in around 3.6%. And that's pretty much where we've ended up. So despite the tariffs and the volatility that's occurred in some of the financial market movements, we actually haven't ended up in a very bad place. So we're pretty close to our inflation target. Core PCE is just a little bit off of where we'd like it to be. It's at 1.7. We want it to be at 2%. The unemployment rate's still quite low. By historical standards, it's really quite low. And GDP is growing roughly at what we would expect, which is around potential. So in terms of economic data, the outcome's been quite good.
Well, Chairman Powell said last week the economy is in a good place. Would you agree with that characterization?
I would. I think we are in a good place. Now, the composition's been a little different than we expected. We expected business fixed investment and exports to be a little bit stronger. We didn't expect consumption to be quite so strong. So the imposition of the tariffs, the global slowdown, resulted in both exports and business fixed investment being weaker than we would have forecast. Consumption, though, has picked up and been quite strong, and we expect it to continue.
Would you think it would have been that way without the Fed's rate cuts? You dissented on all three of them.
So we would have been a little softer in some areas. So residential investment looks like it's picking up. But one of the challenges, I think, is thinking about what the side effects are of very low interest rates. And there are two side effects that I am particularly continuing to worry about. One is how much room we have if we actually do get an actual slowdown as opposed to a concern about a slowdown. And in that case, we don't have that much room before short-term interest rates would hit zero. The second concern is that right now the stock market's been doing quite well. Other financial markets in some areas have been quite ebullient. And the question is this the stage of the cycle that you want to have a little more push to financial markets? And I would argue I'm not so certain that that's necessary.